Today, the great bond sell-off. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The US 10-year bond rate has spiked higher in response to strong employment growth and comments from the Fed suggesting that interest rates in the US could rise faster and further. So we discussed the news, and in short, the global sovereign bond market breadth is looking sick. And by the way, if you value the content we produce, please consider joining our Patreon program, where you can support our ability to continue to make great content. Here's the link, and it's in the comments below. The US 10-year bond yield has spiked to 3.195, up 1.06% as I write this, and it looks to be set to climb higher to levels not seen in more than 7 years. The ADP National Employment Report showed private payrolls jumped by 230,000 jobs in September, the largest gain since February, while a report from the Institute of Supply Management showed services sector activity hit a 21-year high in September. Simply put, when the economy is firing on all cylinders, and when traders have reason to defend against the possibility of even faster growth and inflation, something today's data may well suggest, rates are forced to move higher. Traders now see a 78.8% chance of a 25 basis point hike at the December meeting of the Fed, up from 77.4% a week ago. In contrast, the 3-month bond yield rose only 0.09% to 2.225, so the signs of an inversion have not really changed much. But it's worth looking more broadly. Here is an interesting picture with the red line showing the 200-day moving average breadth of global bond yields in the developed markets. In other words, it shows what proportion of global government bond yields are trading below their 200-day moving average. We are seeing fewer and fewer 10-year government bond yields trading below their 200-day moving average. This suggests that government bond yields will continue to rise. The signs are there. And in that context, the US 10-year government bond yield is the bellwether. But there is something else here too. The US 10-year government bond yield is breaking higher at a time when bond market volatility is tracking around record lows. Market watchers will tell you that low volatility is a good predictor of future higher volatility. We often see such low volatility around turning points in the market. So putting all this together, it looks like bond yields will be rising higher with significant consequences for our local bank funding. Already, the BBSW has risen to more than 18 basis points from its February lows, having tracked lower recently. The changes in the US 10-year rate will flow through into the international capital markets and on into funding and local mortgage rates. And indeed, US mortgage rates already skyrocketed in relative terms. It was the single worst day in nearly 2 years, and among only a few days where effective rates moved more than 0.10% in a single day. And then additionally, Aussie will go lower. The exchange rate with the US dollar has fallen to 70.90 and is likely to fall further. Not only does this risk importing inflation into Australia, but it also puts more pressure on the RBA to lift the cash rate. Foreign money could well flow out, seeking the higher returns on offer elsewhere. The big Game of Thrones is truly in play, and it looks as though we are going to be left holding the damp end of the stick. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.